Welcome back to Behavioral Finance and FinTech. I'm Andy Kim, your Dr. Finance. In this video, we're going to talk about the behavioral finance aspect of capital structure theory, market timing. And then we'll move down to the catering hypothesis, where the name changes affect your stock prices. All these things are about rational CEOs entertaining those irrational shareholders or investors in the market. Okay? So let's go. Capital structure theories, right? Review. Well, I say list up the 5 theories of capital structure and explain. How would you do it? And you'll be like, capital structure theory? What did I learn? Financial management? Damn, I did not learn anything in my, previous finance class. Don't say that, right? You learned a lot. By the way, I know, right? 오종민 교수님 must have taught you a lot, and then other great professors must have taught you a lot. 5 theories of capital structure. What did you learn? Originally, you started with M&M, Modigliani and Miller. Right? Modigliani, it's not Modigliani, it's Modigliani. This is Italian, right? So G is, you don't pronounce that. Modigliani and Miller. What was that about? Well, the debt versus equity mix, right? How much, what percentage of your capital structure comes from debt as opposed to equity? Should that affect the value of your company? Okay? Should that? Well, your project, let's say it does not change. It's just a foundry business that you're going to do it. Samsung Electronics, good luck. But whether you raise debt as opposed to equity, would that capital structure decision additionally increase or decrease the shareholder value is a question. Then M&M say what? No, the capital structure decision is irrelevant to firm value. Okay? Irrelevance theorem. Modigliani and Miller has a couple of theorems. They consistently say irrelevance. Why? Because they start with very unrealistic laboratory setting assumptions. For example, no transaction cost, frictionless world like in the out in the space, not in the earth, right? Frictionless transaction cost is not their default. What is that? Bankruptcy cost is 0, and all this kind of everybody's rational, and then market is efficient, and all this kind of things. You assume it, and then in that equilibrium model, right, your capital structure decision would not affect the firm value. But don't pick on the professors and say, oh, Modigliani and Miller, you're so naive, professors. You don't know the reality. The reality, I will teach you. I have work experience. I'm going to teach you, professor. No, don't say that, right? This, Modigliani and Miller irrelevance theorem is just a starting point. And they say what? Under this unrealistic assumptions, it should not affect. But one by one, let's drop those assumptions and you will see that those capital structure decisions, in fact, affect the company value, firm value. That's the beauty of this theory. It's not about, totally away from the reality and then philosophically talking about whatever. No, they give you a good starting point. Like a straw man, here's the model of a human being. Now let's get realistic. It gives a room like that. So that's why M&M is such a great theory. Okay? Irrelevance theorem was the first point. And then one of the most important part of M&M was about the trade-off, right? Let's get realistic. Tax is there and bankruptcy cost is there. 2 important frictions in the real world. So what does that make? How does that make difference? Well, tax says what? By borrowing money from the bank, you pay interest and the government subsidizes you in the form of tax deduction. right? 손금산입, if you learned about what tax law, CPA guys, right? So that you save your tax by borrowing money. There is a tax benefit by borrowing something more and more. Okay, if that is the case, why don't I finance my whole business 100% by borrowed money, bank borrowing? And why don't I just skip or not invest in equity as an owner? Okay, $0 invested as equity owner, right? 0, 100% debt financed. Why don't I make it that way? Well, we call it bankrupt, right? There is a huge debt burden associated with this debt, borrowed money. Fixed amount you have to pay every year in the form of interest payment as well as principal payment, right? How would you, right, take care of that? Plus, if your company is more likely to go bankrupt immediately, your customers fly away. That's intangible cost. Another, indirect cost, right? Another, your suppliers, right? They fly away. That's another bankruptcy cost, indirect. More importantly, your lawyers are lurking around you. Bankruptcy lawyers, you're bankrupt. Once you go bankrupt, come to me and I'm going to, take care of the situation. You just pay me money. Hourly pay to the, 변호사, right? This bankruptcy lawyers skyrockets, right? At least a couple of $1,000s per hour or something. Bring me money. Yeah. So bankruptcy cost is non-trivial. So there is a trade-off between these two. Borrowing money gives you a trade-off between these tax benefit and bankruptcy cost. So trade-off theory is there. And then where you, depending on how you determine the mixture between debt and equity, will be about, hitting the balance between these bankruptcy cost and the, the interest tax benefit of borrowing. That's trade-off theory. Pecking order is the third one. And I know, 99% of you only remember this pecking order theory because it has a connotation with the animal. Nice way of, in the advertisement, if you learned about advertisement in marketing, right? There are a couple of things that draw human attention quite naturally, immediately. The first is animal, the second is babies, and the third is sexuality. Now, pecking order starts with the bird, right? So that's why you easily remember, right? There's an order, just like, which the rooster goes first and the hen goes next and then the chicken goes third, or the other way around, I don't know, okay? Or the priority. Or even for the same bird, like a hen over here, there's an order of picking the most favored food, and then the second one, and then the third one, pecking, woodpecker kind of ideas, pecking order. Nice and clever. But what was that pecking order theory about? Okay? It was about information asymmetry. Okay? Perhaps this is the information asymmetry between the CEOs and then the outside investors, right? What was this about? Well, it's about, the quality of the project. I told you, Samsung Electronics decided to go into foundry business, right? But the quality of this project, foundry going into there or not, outsiders don't have any idea. I don't know what the heck the quality of the project is, right? Yeah, someone may say, yeah, it's Samsung, so it shouldn't be a great quality anyway in the first place. Maybe. If that is the case, why is the stock price going down? By the way, okay? So, how can I infer the quality of this foundry business project that Samsung Electronics jumped in? Well, one way of inferring the quality of the project is by looking at their debt versus equity mixture in financing that foundry business. How would they finance it? Okay? There are three sources of capital they can utilize to support those foundry business. 31조 원 every year, like $31 billion every year. Right? How would they finance it? Three different ways. One, first and foremost, your internal cash. Okay? Out of your net income, whatever you plow back, reinvest to your business, that could be a very strong cash or capital to support your business. Second one is debt, bank borrowing or issuing corporate bond, right? Fixed interest rate, you pay it, and that's it. Third source of capital is issuing stocks, issuing equity, 유상증자, or we call it seasoned equity offering. Of course, if it is your first time to going into the stock market, we call it IPO, initial public offering, which Kakao Pay is doing, right? Coupang did it, right, early this year. And Samsung Electronics did it like 30, 40 years ago. So now what they do could be issuing equity if they choose to. But the choice of this source of capital to finance the project, the choice of the capital structure, right? Choice of the source of financing works as a signal about the quality of the project, foundry business. How much promising is it? How much jackpot, 대박 is it? Right? We can infer it from the choice of funding source. Okay, the first funding source, let's talk about this one, internal cash, right? If your business is most promising, okay, biggest jackpot, would you ever want to share this thing with outsiders? And the answer is hell no. If you can, you want to preserve it to yourself. That means existing shareholders want to enjoy the full benefit of this full jackpot, right? So if you can afford, you will finance it with internal cash only. Okay, retained earnings and then just internally finance it. So announcing those foundry business and then together with it, if the company say, we're going to finance it through our internal cash, then people will be like, yes, we infer something greatest about your project. Otherwise, that tells us about the quality of it. It's an information game, signaling game going on. That's the first pecking order. Second one is what? If your project is reasonably promising, okay, middle level, right? Then what would you do? You will finance it through debt. Okay, why debt? Because you don't invite any new shareholders. New shareholders can be troublesome to existing shareholders. Your ownership and the power, the control right dilutes. So you don't want to invite them. And then you still raise money. And then you have to pay interest expense every year, a fixed amount. That's good enough, right? That's better than sharing my ownership and then, risking my ownership position. Right? Control rights is important one. So debt financing is a second order one. When we hit the jackpot, we hit the jackpot and still pay the principal and interest expenses, and the remaining part of those jackpot pot comes into the equity holders, the existing equity holders, and the CEOs. So we are happy. So if the foundry business is announced with financing structure saying that we're going to borrow money to finance this one, then people say applause. Okay, fine. Okay. The last thing you want to do is asking for new shareholders. When do you do this? When the project is not that much promising. If there is a huge downside risk as well, what would you do? Huge downside risk, you cannot afford to do that because this one, you have to repay the debt anyway, even if you hit the downside like crazy. But for this one, if you hit the downside like 쪽박, let's die together. And new shareholders and then existing shareholders die together. Okay? What if, on the other hand, if it is jackpot? Yeah, we hit the jackpot together and we split it. Okay? You don't like that situation, but in the downside, you're protected together with the new shareholders, right? So there is a trade-off that you see, right? And then if the company announces that we're going to finance this guy with new equity issuing, you can infer, there's a lot of downside risk going on. So they don't want this kind of investment, right? All this kind of signaling game happens because of the information asymmetry, and that's pecking order theory, right? Fourth one is agency cost. What the heck is that? Well, all these theories of capital structure is about explaining why different companies have different capital structure, debt to equity ratio, okay? We don't have uniform optimal solution, right? All different companies have different tendencies like that, variations. And we can explain from different perspective, like trade-off, M&M, pecking order, and agency cost is the next one. Agency cost is what? Well, I have to talk about the barbarians at the gate, okay? Barbarians at the gate. That you borrow money in your company to discipline the CEOs. Discipline, whipping the CEOs and then make her run like 100 kilometers per hour like crazy. That works as a disciplinary tool so that they would work hard, okay? Instead of laid back and doing nothing. What do you mean? Well, RJR Nabisco, okay? That was a cookie company, Oreo cookie, Oreo. Yeah, even the North Koreans will know about Oreo cookie, right? Long history company, strong brand equity in confectionery as well as the cigarette, Salem kind of things, right? Anybody smoke cigarette? Don't smoke it, but it's a famous one. Strong brand equity. People keep on smoking. People keep on eating Oreos, right? So after a long history, their equipment is fully depreciated, and then they are left with free cash flows. Okay, not much of an expense going on. The business goes on, even without working hard. They just go on. It's a money-making machine still standing over there. What happens to the CEOs? They don't pay attention too much. And with this flooded free cash flow coming in, what do? They purchased 32 different corporate jets, private jets, Gulfstream, right? 32 of them. They said RJR Air Force. Why do you need that many corporate jets, right? Samsung Electronics, by the way, used to have only one. Nowadays, they don't have it. Maybe because of some socialistic sentiment, but they need one or two at least. But RJR, they had excessively many. Okay? That's too much. Wasting shareholders' money. And that's American case. In Korean case, what happens? Well, CEOs waste the shareholders' money by buying Rolls-Royce with company money. This is company car, but I ride as a CEO, and my son rides, or my daughter rides, my wife rides Bentley, and then this kind of luxury cars, right? Lamborghini, corporate car. Why isn't it your personal car? A lot of them in the Seongbuk-dong area, and scares me when I'm driving. But that's a symptom of agency problem. Yeah, agency problem. The CEO wasting shareholders' money. How can we discipline these guys? Not by communist revolution. No. Right? But by capitalist discipline. That's debt borrow huge amount of money, 10 times the equity. We call it leveraged buyout. Okay? Borrow huge amount of money so that you will have huge amount of interest expense to take care of, so that the CEO has to work hard like crazy. And then the capital structure happens, is a solution to this kind of agency problem. That's agency cost theory. The last one is market timing. The previous four theories were economics, neoclassical approach. Everybody is assumed to be rational, utility maximizers. But the last one is behavioral, right? Here, what's the idea there? Well, here, the CEOs and CFOs, let's assume that they don't care about the trade-off or pecking order or agency cost or any other thing. All they care about is debt market versus equity market, which capital market is more beneficial or easier to raise capital, which means the cost of raising capital is the minimum. That is when equity, for example, is optimal for you. It's good to raise stock, issue stocks in the equity market when the equity market is in a bubble. Like these days in the US market, S&P 500 hit another, historical high level, right? And that means everybody in the market, investors are irrational and they are too much excited about the investing in stock market. So the raising capital, raising stocks, right, doing IPO is cheap these days. Cost of equity capital is very, very cheap. So if I have a choice between these two, why don't I go to the equity market? Yeah, bubble time, I go there. And crash time, I don't go there. Instead, I go there, debt market, to borrow money, to finance the same project. Okay? So that's market timing idea. Which market is in more bubble, right? Bond market could be in bubble too. This market, obviously, you see the bubble going on over there, right? So it's about timing those markets, okay? Minimizing the cost of equity or cost of debt, whichever it may be, cost of capital, WACC, right? So market timing was the idea of taking advantage of investor irrationality. The other four are just rational models, right? Now, US CFO survey result. Duke professors, Graham and Harvey, you see these guys, they did a paper, wrote a paper, and where they surveyed the biggest corporations in America, like 300 of them or something, asking those CFOs for surveys. Of course, they tried with thousands of them. Response rate should have been a lot smaller. So that's why they ended up with a couple of hundreds. 44% of the CFOs said we try timing when cost of borrowing is lowest. And that tells us that US CFOs, they, raise capital in the market timing manner, behavioral finance support. Suppose rational managers, managers are irrational and investors are irrational. And suppose that managers know when the price is not equal to true value. What would they do? Okay. Market timing is one way of doing it. And then in corporate finance, basically that means issue securities, increase stock when price is greater than true value, repurchase, reduce S when reduce stock, the equity part, right? The number of shares outstanding when the price in the market is smaller than the true value, okay? Expected P star, like true value. Anyway, so that's that. And then catering hypothesis is the next one to tackle. Catering is a nice and easy phenomena. Okay, catering, hotel catering, food. You can think about it that way. Now, name change is the most famous phenomena over here. Okay, yeah. So catering is more likely when it doesn't interfere with long-run investment policy, i.e., when it does not reduce true value. The manager, when managers can profit from short-run overvaluation, and when managers can, when managers have short horizons. When did this thing happen? Well, one example is changing names. A rose.com by whatever name. Okay. Well, Cooper Dimitrov and Raghavendra Rao of Cambridge, right? They published a paper in 2001. What was their study? Well, they looked at dot-com bubble period and then the company's behavior in changing their names. Whenever they change names, they have to announce it, right? Disclose it. And then they examined the 95 cases of the name changes, so that they changed their added .com to the company names. That was .com bubble periods. Whatever .com, we are so excited to invest in your company. So with a simple announcement of simple name changes, without much of a change in their business structure, okay? Internet business or not, whether you do it or not, it doesn't matter. As long as you change your name into .com, we buy you. So that with the announcement, the abnormal return was like 74% abnormal return after controlling for those market risk or whatever risk it may be. Okay, 74 immediately, without the real fundamental business connection to the internet or whatsoever. This is the graph. Average abnormal returns going on. Yeah. So that's how the CEOs cater. I mean, imagine, right? You're the company CEOs, right? You're the company CEOs, and you have a call option on your stock that is expiring pretty soon. Wouldn't you announce a name change into .com so that your price of the stock jumps up like crazy without any change in fundamentals in your company, and your CEO did not have to do any hard work and then exercise the call option at a higher level? Wow, party time, man. That's what this is about. Okay, catering hypothesis. Irrational investors and the shrewd rational CEOs. Like a catering those guys and then maximize his utility. Good. Now, you may also question, well, that was .com bubble period. Everybody got excited about it, right? But pretty soon, .com crash happened as well. Those NASDAQ bubble crashed immediately. After a couple of years, people got sick and tired of the name .com. Oh, but your company already has .com in your name. What would you do? They did another research related to that. The solution? Don't worry. Just drop .com and the stock price increase. They found 60% abnormal return, about 60%ish. Without changing your fundamentals, but by just dropping the .com. So attaching .com and then attaching .com and detaching .com, you double bang it. Yeah. 병 주고 약 주고. It's like, that's what the catering theory is about. When the CEO has a short run perspective, right? Short term oriented, they do it. They found this guy. All right, these guys found that kind of phenomena. Yeah. Oh yeah. Did I say 60%? No, sorry. 20%, right? 20% ballpark. Yeah. Attaching and detaching .com, right? Yeah. So that's that. What's the implication for us these days? Some people say it's Pax Technica. I like it. Great. Yeah, I told you. Machine learning era. So sexy, AI. It's all the same statistics, but when the researchers say it's a statistics showing the correlation between X variable and Y variable, it's not interesting. When you frame it, statistics, nobody watches it. Machine learning, still not many people watches it. But the same thing, if you frame it with the name AI, people like to see it. AI bubble, yeah, crazy. Facilitated even more by the pandemic. Wow. Okay, a part of it may not be bubble because of the pandemic that will stay here forever, right? But significant part of it may disappear. And nowadays, everybody, if you want to draw attention and then raise capital, you want to attach AI in your name, right? A couple of years later, maybe a decade later, when people get sick and tired of AI, what would you do? You already have AI in your name. Detach it, right? That's it. That's Catering Hypothesis. So I hope you liked it, and then see you in the next week, right? Next week I'm going to discuss some valuation technique, relative valuation technique, and demonstrating how to download those data together with you, right? Hope that it will be interesting to you. All right, see you. Bye-bye.